Hey everyone, you might be surprised to read the title of this video considering that FSLY stock is down so much off its high. You might be surprised that valuation is my sticking point. But I'm going to share with you some details on why that's the case, on why valuation is not about the market price, but more so about the value you're getting for the price that you're paying. I'm also going to go over the latest developments for FSLY and the progress it's making, and why, if the valuation was cheaper, I would seriously consider upgrading this stock to a buy. So let me start with going over what's been happening at the company, and then I'll share with you a little bit more about valuation.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, so FSLY, in its latest quarter, its free cash flow was negative 21.9 million, a 2 million sequential decline from negative 19.7 million in the third quarter. More importantly, however, for the full year in 2023, free cash flow improved by 113 million from negative to negative 59 million. That was better than the negative 172 million in 2022. So it's reducing the negative free cash flow year over year. The improvement was driven by approximately 70 million increase in cash flow from operations and a 42 million in reduction in advance payments for equipment. I like both of these reasons for the improvement. Number one, an increase in cash flow from operations is the primary factor I look for when I'm evaluating free cash flow. I want to see its cash flow from operations improving. Notably, companies typically report cash flows in three segments: from operations, from financing, and from capital investments, from investing. You would like to see companies growing in their operations. The operations are not unlike an individual or a household generating money from their job, from their day-to-day activity. That's where you want to make money from. Financing is not unlike a household generating cash by borrowing money, right? You can borrow money from your credit card, from the bank, for a mortgage. You can borrow money in all sorts of ways and raise cash. Well, that's not too exciting, right? If somebody told you, hey, I just got $100,000, and you ask them, how did you get it? And the person says, well, I went and borrowed it. Well, big deal, right? Anybody, well, not anybody, but borrowing money is not that hard to do, right? If your credit is good and you have a certain amount of income, you can borrow a certain amount of money. That's not really where you want to generate your income. But if somebody were to tell you, hey, I just made $100,000, how did you do it? Oh, I created this product and I sold it and I made $100,000 in profit. That's more impressive, right? That's more durable. That's more longer lasting. You can now create another product and do that again. That's not unlike a company. You want to see a company generate money from their operations, from their what they're good at, what they're in business for, not generate cash by borrowing money, selling stock, whatever that case might be. Also, the investment segment is another one you typically don't like to see a company generate money from, right? Just like a household, you can make money by selling your house, right? A house would be categorized as in your investments category because it's a long-term asset. You could sell your house and get cash, but you're giving up a valuable asset to get that cash, right? You would much rather get cash by selling a product or a service or through your course of your job to generate money. So that's why when I'm evaluating a company, I look for cash flow from operations. That's the area where I want to see improvement, and FSLY definitely demonstrated improvement in free cash flow, specifically from cash from operations. Now let me talk about its valuation. So first I want you to understand the price to earnings valuation metric. The price to earnings ratio is an important financial metric I use to determine which stock is more expensive or if a stock is too expensive. Let me show you this example here. I have two stocks, one trading at a market price of $100 and one trading at a market price of $12. The one trading at a market price of $100 has an earnings per share of $2.58, while the other has an earnings per share of just 11 cents. When we look at their price to earnings ratio, the one trading at a market price of 100 is trading at a price to earnings of 38.76, while the one trading at a market price of $12 is trading at a price to earnings of 114. So in this example, the one trading at a market price of 12 is actually more expensive because I'm paying 114 times earnings to purchase this stock. That means if the company was to pay me earnings per share every year as a dividend, it would take 114 years for me to receive my money back. Whereas the other stock, it would pay me back in 38.76 years. Now, there's a lot more to think about in this equation, but to simplify, that's an example that shows you why a company with a market price higher can actually be cheaper than a company with a market price that's lower. Okay, so now that you have an idea of the PE ratio, you can see here Fastly trading at a forward PE of 79.89. That's expensive. Even though it's down from its peak, the average stock in the S&P 500 is trading at a forward PE ratio of around 18 to 20. So Fastly is roughly 4 times as expensive as the average stock in the S&P 500. So that's why valuation is a sticking point for me with Fastly. Even though I shared with you already a couple of key metrics, let me share with you a couple of more. So for the first quarter, they expect revenue to grow by roughly 13% at the midpoint. And as a result, they expect their first quarter GAAP operating loss to hit a midpoint of between 14 million and 10 million. More importantly, however, for the calendar year 2024, they expect revenue in the range of 580 to 590 million, with 16% being the growth rate at the midpoint. But management noted that they expect to exceed those expectations for 2024, and they already proved that they do that, and they exceeded expectations for 2023. And finally, they expect their operating loss to improve to a range of 20 million to 14 million, representing an operating margin of negative 3% at the midpoint, which is an improvement of over 50% from 2023's operating loss of 7.2% and 2022's operating loss of 17.7%. So I see a clear trend here where Fastly is reducing its loss on the bottom line from 17.7% to 7.2% and 3% expected in 2024. All these factors I like to see from a company improving those losses. Even if they're not profitable on the bottom line, they're moving in the right direction. So I'm seeing a lot of good things out of Fastly stock. The sticking point for me is valuation. So if this valuation comes down, and it would need to come down significantly more in terms of the forward PE ratio, I would seriously consider upgrading Fastly stock to a buy because the other factors are moving in the right direction. Thank you for watching this video. I truly appreciate it. I know there's a lot you could be doing with your time and a lot of other videos you could be watching. So I truly appreciate that you chose to watch this one. If you want to see more videos just like this, hit the subscribe or the like button. They'll both help me make more videos just like this one. Thank you again.